Traders, good morning, good afternoon, and good evening from across the globe. Thank you for tuning in. Metastock, thank you so much for inviting me. You know, Metastock puts together some fantastic shows. They have these webinars every few months, sometimes every few weeks. I've been using Metastock since, I don't know, I'm 18 years old in 1982, and I've used everything out there on the street. And I will tell you, Metastock is my go-to program. Thank you guys for making my life so easy with Metastock over all these years. For you traders out there that are tuning in to see me, some of you know me, some of you may not. My name is Oscar Carboni. You can always find me in a live trading room on camera and microphone most of the time when I can do that. But I'm always there at livewithoscar.com, and I just want to go look at some charts. I'm not going to try to sell you any programs. I'm not going to try to show you anything that you don't know. What I would like to do is go over a series of charts with you that we actually went over in the last Metastock webinar, and they had a lot of action on the charts, each one of them. And those charts gave us little tips and tricks to use moving forward. So we looked at the charts in the shape they were a couple of months ago, and those very same charts I am going to bring back today, same charts we used in our last webinar, to see where we're going and if there are some new tips that we can use moving forward for the next few weeks or months ahead. So we started out with a Russell 2000 chart in our last webinar, and it was ugly looking like this one right now. But let me just remind you before we get started that this is a very risky game. There's a lot of risk in trading. You've got to know that. You've got to use protective stops anytime you're going to trade. You put those stops in before you even get into the live position, and then at least you have insurance against something going wrong. It's a very risky game, and you can lose more than you've got in your trading account in futures. Know that. And put your stops in first, okay? Now, how do we mitigate the risk? We use charts because I can tell you, 41 years doing this, there is no better roadmap on this planet than what you are looking at right there. The chart is a technical look. Well, it's really a visual look at all of the information that comes out, government reports, what people think about those reports, how traders react to those reports, what the funds are doing, the news that didn't come out yet, the news that already came out, insider trading. You know where all of that is? It's all built into this chart. And you know what the chart doesn't have? Human emotions. It doesn't have BMW payments. It does not have alimony payments, child support payments. It doesn't have a reputation. The chart is pure. And if you can read the chart correctly, you know where the markets are going next with a better degree of accuracy than anything else that you can come up with. A clean chart and a good pair of eyes with a good chart read can tell you everything you need to know. So what does that mean? When we were looking at the Russell 2000 several months ago, we had this nasty head and shoulders formation, which dropped down into what we call a bear flag, this purple bear flag looking formation, created a smaller bear flag inside of the big bear flag and proceeded to crack. Now, interestingly enough, in front of your eyes, our last webinar, we gave a projection of 1698, and that was exactly where the market got down to. In fact, the low on that drop, thank you technical analysis, was, what's the low here? 1698.30 was the low of the drop. We called for 1698 using technical analysis. Where was the low? Well, we expected it to hit the low of the channel. When it did, that was the exact projection, and it bounced. So does analysis work? My goodness, these things work so well. So in the past, that's what we had. And what we talked about on the Russell 2000 was this. We need to get above the 200 bar moving average, which is this teal moving average right here, which, as you can see many times when it tries, gets up there and fails, gets to the average, drops, gets back to the average, has a little bit of trouble, then fails. So we thought from looking at the chart a few months ago, it needs to get above the 200 bar moving average and above the red resistance line to turn the tide. Well, let's see where we are now. Has that happened? Let's pull some of this stuff in and see what we've done. Now that we've advanced, Yes, we have gotten above the resistance, the red line. We are above the 200 bar moving average, and we've had this is powerful. The street loves it. They think it's something that they should pay attention to, and that's why I do. I don't care if there's a real reason behind it. I don't care. The street watches it. I watch it. So there's something called the golden cross. That's when the 50 bar moving average gets above the 200 bar moving average. The 200 is teal. The 50 bar is blue. When you get a crossover, they call this the golden cross, and I assure you that Wall Street starts to pay attention to golden crosses. Since then, we have started to move higher, and if you'll note, let's go back a little. In this chart, we were in this nasty red channel, moving lower, below the 200 bar moving average, below resistance. Where are we now? Well, we are above the channel. There has been a golden cross. We're above the 200 bar moving average, and look at how the channels are now starting to point north. This is the new channel that's developing. No more ugly red channel pointing lower. You've got a new channel pointing north. You've got to love that, right? So it doesn't mean it's going to go up every day. But now we're starting to see that we're getting out of that insane downward movement channel, trend channel that we've had, and we're starting to build some positive things here. Golden cross above the 200, channels are working higher. So that's where we are now compared to where we were. And I believe on each one of my charts, I've got sort of a where we were and where we are now and what can help us moving forward. So we will look at a lot of charts today, and I think you will find many of these are going to help us. Next chart on the docket, the E-mini S&P. By the way, if you've got questions, please write them down. At the end of my chart segment, I'll be happy to answer any of your questions about any of these charts or others if we have time for it. Now we're looking at the SPX, or the S&P daily bar chart. When we looked at this last, we had our opinion. It needs to get above the 200 bar moving average. It needs to get above the red line resistance, sort of just like the Russell. Well, what have we had happen since? We are clearly above the 200 bar moving average now, clearly, because it's here. And every time we've gotten to it in the past, we failed near the trend line or at the trend line or the 200 bar moving average. So that tells us we need to get above it and above resistance to change the tide, right? Well, time has passed, and here we are now. Let's move this little tool over here. Look at where we are now, above the 200 bar moving average, above channel resistance, and we are very close to seeing a second, which is a beautiful thing, golden cross. It hasn't crossed yet, so you can't say it's crossed, but look at this average. Look at how close. Let me blow that up for you a little bit. Look at how close we are to a golden cross taking place right there. So Russell, golden cross. The street pays attention. I promise you they do. Even the S&P is above the 200, is above resistance, right? A possible golden cross, and now channels are working higher. So we've got upward channels, golden crosses, happier days ahead are what the charts are starting to tell us. There's a theme building here, and 2 weeks ago, the charts looked terrible. Suddenly, they are starting to look much better. So I want to look at a lot of charts and make sure that this technical picture that's developing is real and not just on a couple of charts. So we're going to look at a lot of charts today. One of the charts that we looked at in our last presentation, the NASDAQ. What you can see in the NASDAQ clearly is the 150 bar moving average, not the 200 in this case. The 150 bar moving average was the absolute end-all be-all for NASDAQ rallies. So what does that mean? We get under the average right here for the first time, and it stays under, tries to rally. Look where it fails, right at the average, right? Into a bear flag, down, down, down we go, bottom of a channel. Where's it go? Just gets above the average, failure, down we go. Where's it go again? Right back just above the average. Failure at the trend line. Down we go. What happens here? This turns green. That's no longer red. We make that ellipse green now. And look at how much more exciting it starts to become. Now we are above, finally. Finally, we get above that red, that purple resistance line. We are above the 150 ball moving average. And guess what? The street pays attention to this, I promise you, the 200 ball moving average. We are above that too now. That 200 is right here. So let me blow this little area up for you just a little bit. The 200 ball moving average is that teal average sitting right there. We're above that. We're above the 150. We're above resistance. That's different, kids. That's not the same picture that we've been seeing. It's getting more bullish out there. In fact, the market is changing complexion right before our eyes. Slowly, luckily, because we don't want it to turn quickly, but the stock market itself, the street, Wall Street, is starting to change complexion. How would we know? We did not fail as usual in this area. Suddenly we get above instead of another failure. Well, finally above. And above the 200, I kid you not, that's different. The street will pay attention. So NQ is above the 150. Congratulations to the NQ on that move. It's also above channel resistance, this purple line. And now, here's the tip on this chart. Maybe the 200 ball moving average has hit the driver's seat. If the 200 ball moving average is in the driver's seat, that is what you'll be using to cue off whether you should buy or sell NASDAQ for the next few weeks. Keep your eyes posted on that. The first strong tip that showed up in my analysis session. But of course, we're not done there. Another chart that we looked at was same thing, NASDAQ, but like the Russell, back in the day when we first did these webinars a few months back, it had a nasty head and shoulders, massive head and shoulders building, right? You've got the left shoulder, the head, the right shoulder represents the next move is going to be lower, basically is what that tells you. What happens? The market does drop, comes rallying back up for a last gasp of air that we call the Oscarism known as a head test. It failed at the head test, and where else? More importantly, at the 200 ball moving average. Right there in that red circle, down you go, smack. From that point forward, it never hits the average again, just cannot get out of the channel. What has happened in the last few days? We are out of the channel. Beautiful thing, right? Above the channel. Above the 200 ball moving average, and once again, channels are now starting to point north, not south. Look at the blue channel forming. So I'm starting to see a slightly more positive picture of our indices, a picture that may allow me to take off my whiteboard in my nightly videos the sentence, "Do not fall in love with the upside." That may be able to come off soon. So as we move up a little bit, we blow up this chart. Some things here that we need to discuss. Hooray, above the 200 ball moving average. Wall Street loves it. We are above the red resistance channel. New channels, the blue ones, are working higher. So the tip here, holding above the 200 ball moving average will signal Wall Street funds to plow in. That's what will happen. We just need now to stay above and let the algorithm start to pick up on the fact that it didn't just get above once, it's above and staying above. That will help the markets move higher in the next few weeks. Just need to stay above that average. And what else is on the docket? Again, I'm only going over the same charts we used in our last webinar to show that these charts are congruent. You continue to use them and they give you fantastic signals along the way. So the Dow Jones Transportation Average, there's a lot on here, so let's start back here. Way back before Russell, S&P, NASDAQ, or Dow even recognized we were having an issue, two markets recognized it. Capitulation day took place in the Dow Jones Transportation Average and in T-bonds. The Transportation Average capitulation day is there. From the from the close of this big green spike bar, I literally put this sign there and I said, that's capitulation. There's no need to even ask. Look at the size of that bar compared to everything else that happened. Capitulation takes place. That starts the top of the red channel moving down. As you can see inside this red channel, you could not get out of it no matter what. I mean, no matter what this market tried to do, it was just held captive inside the channel. From top to bottom, just held captive, right? Boom, down to the bottom, up to the top, where the 200 bar moving average gets involved. Down to the bottom, back to the top, where the 200 bar moving average gets involved. Remember the golden cross? We've had two. This is the third one I'm about to show you, golden crosses. Well, the opposite of the golden cross is called the death cross. That's when the 50 bar moving average, the blue, gets below the 200 bar moving average. Or let me just say the death cross is when shorter term moving averages get below longer term moving averages. So here you have a death cross. And what happens? You spiral lower almost immediately. Start making lower lows and dropping. Death cross took place. The street pays attention. Now they see there's a golden cross that has taken place. That's the happy side of the death cross. Now you've got 50 bar moving average, the blue, above the 200, the teal. The street is watching. So what does this chart show us? The golden cross, smaller averages above larger averages, has taken place. Channels and averages are starting to point up now instead of down. And as you can see, red channel pointing down, death cross, averages pointing down. Well, what do we have now? Averages pointing up and channels pointing up. You see, kids, there's some light at the end of this tunnel. We're starting to have a better looking market. That doesn't mean we cannot go lower, but I'm reading you the tea leaves that take place today on January 30th, 2022. We are going to start to work higher if this continues. I have been buying dips. I am a buyer of dips. Today, I tried to buy the dip, and we were stopped out in NASDAQ. It didn't work today, this morning. Sorry to say on the X, but it's only Monday. However, buying deep dips in this environment, let's not speak day trading. Let's talk swing trading. Buying deep dips inside this blue channel above the golden cross and above the red resistance, which is now support line, is probably what we want to be doing with the transportation average. So the tip is the landscape or complexion is absolutely changing. Projections are now coming in higher instead of lower. All right, love it. Let's see what else is out there. Back to the Russell 2000. Reason? Because this is one of the charts we used on our last webinar. I can't not bring it up. All right, so Russell 2000, we had the left shoulder, head right shoulder, which absolutely worked, created the bear flag, which dropped down to the projection we spoke about earlier. But I guess why I had to bring this one back up was this. In the past, we talked about this chart and said, will the double bottom here hold? Well, triple bottom, I'm sorry. Will the triple bottom here hold? And it must get above the 200 bar moving average and resistance to become, to turn the tide, so to speak. Remember, traders, good chartists make projections, not predictions. None of these are predictions that we make on these charts. We're just projecting based on formations and such. The projections tell us that we're starting to project higher, so to speak. So people's predictions, if you will, that I don't make, should be projecting higher now that we're starting to show it on the charts. Okay, so it all began here with the Russell. I kid you not, the Russell was the first one to crack. It was the first one to put the head and shoulders in. Yes, transportation average had a capitulation day, but then it sort of mellowed out. The Russell immediately went into a big bearish formation, secondary bearish formation called the bear flag, cracked seriously. But when we looked at this chart last together, we were at the triple bottom. Will it hold? There's a question mark here. Well, absolutely. Let's get rid of the question mark now that we're back to this chart again. It did hold. Question mark gone. That's an exclamation point now. So it held. It rallied, and what did it do? It got above the red resistance. They're all getting above their resistance. I wanted to make sure you can see that. And we've got another golden cross. The street's watching, kids. So golden cross is in above the resistance, Market is working higher, and once again, you've got trend lines moving to the upside as opposed to the downside, which I love seeing. That's what we want to see. The trend now moving higher means slowly complexion is changing. And believe me, that's what we need from these markets. You know, everyone's got 401, not everyone, but a lot of people in this country, in this world, if you will, have retirement funds. Those retirement funds are being traded in the markets, and we want the markets to go higher for the general public, right? For the public at large. You always want the markets to go higher. It's not what we had in the last few months, but it is starting to shape up as a decent size rally thus far. And congratulations to people with 401ks, because believe me, they've gone down quite a bit recently. So what else did we look at in our last presentation? Here's a good tip for you. Crude oil. Look at this one. Simple, powerful. Crude oil daily. We know that crude oil below 77 helps buoy the stock market, but let's just talk about what we can glean from this chart right here. We had downside projections when we looked at this chart last. We made the projections right here, and we expected 83 and then 77. The market literally came down and hit 83 and then eventually hit 77. So the projections worked out. While those projections worked out, something else happened. A big red channel formed. The big red channel started to form here. So now we've got a huge red channel in crude. And what's the tip right before our eyes? Look at how it just fails miserably at the 100-ball moving average. That is your key for direction. If you want to trade long side of crude, do it above the 100-ball moving average, which it doesn't get. If you want to sell rallies, sell into that 100-ball moving average. The stop is not grand. That is the tip I would like to offer to you in crude oil using this chart, one of the tips that I found. And you can see it's having severe trouble ever since it got below the 100. Used to stay above, by the way. Used to stay above and stay above even when it tried to go below. It couldn't. But then one day it did, and it's been below ever since. That has been the trigger, and Wall Street's using it, I promise you. Algorithms basically programmed by this, everything that you see on these charts, what happened in the past. The market movement is what's programmed into algorithms, right? And of course, what to expect because of certain market movements. Well, that movement's right before your eyes. Algorithms don't know anything we don't know, I promise you. You'll see when we get done with this. What's next? 30-year T-bonds. Rates are dropping, pushing the stock market up. Isn't that interesting? Because when we looked at this chart last, we said rates are rising. It's pushing the stock market down because that's what the chart was doing. So how do I know that? Well, look at this ugly channel. Yeah, I'll just do the bottom of the channel line. You can see the top one. All right. So look at this ugly, ugly channel. All right. The top line would be here. I'll make it just a little thicker because I don't want it to get involved in our average. So you're in this nasty channel. And yes, while the bond market futures push down, it pushes rates up. How do we know? It's an inherent relationship. Up here in the corner, I've got what you call a little teeter-totter, a seesaw, like let's say we're out in the park together. The seesaw's got interest rates on one side and bonds on the other. Well, what happens with the seesaw is if one side goes down, the other side goes up. You can't not, it's not going to not happen, right? So in this particular situation, the bond futures were the big heavy kid in the park, and the interest rates was a little light kid, and they kept going up. That was during the big drop. What we're getting now is, look at this. We're starting to get channels, just like in the stock market, working towards the upside instead of the downside. That we haven't seen in a long time in bonds. What else is happening? Right now, use the 150 moving average. It's the simple MA, so it's the simple 150 simple moving average. Use that to decide bond direction. If you hit the average and can't get above, it is an absolute short. If somehow we end up above that average at some point in our lives, you can start buying. But right now, you're going to key off selling that average. So the opposite is the truth. When rates are going down, when futures are going down, it makes rates go up. When futures are going up, like you see in this blue channel, rates are literally starting to go down. We'd love to get above that 150 ball moving average and see rates start to drop a little bit. That's not quite what the Fed wants yet, so one step at a time. Now, here's what's interesting. The bond market, its movement is in direct relationship to what the Fed is doing. Everyone knows that, but here's the visual proof. See this little triangle right here, this little delta? Right there, the Fed shifted its policy from 75 basis point rate hikes to 50 to 25. Right around this area, we started shifting from 50 to 25. And right there, bottom comes in bonds, and they start moving up. Why? Because the Fed shifted its policy from larger increases to smaller increases. Down to quarters now we're going to be, right? So now that we're down to quarters, you've got that whole blue channel building because we went from 75 basis interest rate hikes to 50, now 25. Sure, it's going to push the market higher, the bond market. But it did only push it up to the 150 ball moving average. That's the tip on this chart. Doesn't get above, you can be short bonds. Does get above, keep your eye on bonds for some upside. Let's see what else we have out there. You roll out into a euro currency chart. We did this chart in the last time we did our webinar, and boy, it was really scary looking. If you're in Europe, just think about this, and this is exactly the note that was on the chart. This is a disaster of adding in inflation and the high price of crude. Use the 70 ball moving average to sell short euro, and look at how well that 70 did. Just look at all the great shorts that came off of that trade. That was then. We've got a new chart now. So, same chart, but now we're moving to today. What's happening right now? Yes, we were in that nasty, nasty 70 ball moving average. It's still sitting right here. That was horrible. We have broken above that. It was a bear channel. We are now in a bull channel. We have broken above this ugly red channel. We have gotten above that nasty 70 ball moving average that kept us in check the entire down move. We've got channels moving higher, and oddly enough, algorithm switched from the 70 bar moving average to an 11 bar moving average. So the 70 bar, here's the tip, the 70 bar moving average is no longer in play. Channels are now projecting higher. The tip, use the 11 bar moving average to time the euro. Look at it. Boom, you hit it. It works perfectly. Look at that. And that's what they're using right now. Why would they go to something as small as 11? I don't know. I don't care. I have no need to reinvent the tire. It's already been invented. Put it on my car. I drive really fast with it. I don't care why they're using the 11. I'm never going to even try to figure it out. So they went to a small average. That's what we'll use to time the euro. Let's see what else we have out there. Let's go to Bitcoin. Okay. When we looked at Bitcoin last, it just looked terrible. This is the exact chart that we looked at with all the crap that we found together on it. Big head and shoulders, big resistance line, red, below the 200, a bear flag, another bear flag, just terrible. You can't hide in Bitcoin or Ethereum was what our thoughts were when we looked at this chart last. Just looked terrible. But time has passed. And let's go take a look at what Bitcoin looks like today. There it is. Okay. So all I've done with this Bitcoin chart was basically get away from all that ugly head and shoulders stuff that was over here. I just now took the chart and showed you what's going on since we got above a major trend line. So this is what Bitcoin looks like, just blowing up the right side of the chart. Bitcoin is looking much better. It has broken out of this pennant flag, right? Broke out into a channel moving higher, and this is the kicker. Right now, I don't know where it'll close tomorrow. Right now, at this moment in time, it is above the 200 bar moving average. We haven't seen that in so long, I can't tell you. I mean, look how far back you can go. The highs of Bitcoin is the only time we were at the 200 bar moving average. Since then, we haven't seen it again until now. We are back at that average, and I promise you, the street is looking at this. So, and that should say buyers here. Check this out. So here's what I think we need to do right now. Wall Street algorithms watch the 200 bar moving average in Bitcoin as aptly as they watch it in stocks. If Bitcoin stays above the 200 bar moving average, it will attract buyers, absolutely, positively. That's what's going on with this chart. And I'll tell you right now, that's a good looking chart. Yes, it can come back down, but from the chart that we looked at a second ago, compared to this one, look at this one, how bad that looked. But the important thing was we got above this red resistance line. The most important thing here, if you ask me, is this long red resistance line. So when I show you this new chart, the one that we were just looking at, all I've done was blow up the chart past that red line. See, it's the same red line. We got out of it, and I just blew it up so that you can see what's taken place since. And I'll tell you right now, not bad. Go Bitcoin. I like what I'm seeing in it. Could it turn around and drop? Of course it could, but it looks pretty good here. So what else did we look at in the past that we can glean together? We did Euro, or the dollar index. Okay, so traders, when we were looking at the dollar index last, this is what we said. We see it, we hear about it, but we do not feel inflation barring at the gas pump as much as the rest of the world does. Why? Because the dollar was moving up and keeping pace in some ways with inflation. So while we had this inflationary environment that was building before the Fed started raising rates, and of course built after the Fed raised rates, the dollar went up at the same time. All right, so if prices of things at the store are going up and your buying power currency is going up, it's not as lethal as, let's say, the euro, what was happening in Europe, right? That's what we were talking about in the past. Time has passed. The bull channel has now cracked into a bear channel. The same 70 bar moving average, by the way, worked in the dollar, 70 bar. So it worked in the dollar really well, but it has cracked since. And look at channels now. Channels have changed from blue and happy on the way up, bull channel, to bear channels on the way down. And the algorithm switched. Here's your tip on dollars. Use the 13 bar moving average to time dollars. Why would I know that? Well, take a look at the 13 bar moving average. Look at how well it works on dollars. So currencies have switched to very small averages. All right, because they're moving quickly. That's why. That makes sense, to be honest. All right, what else are we getting? Another channel inside of this channel. So we are getting nothing now but bearish looking channels, where we used to have bullish looking channels. So the dollar is changing complexion, as is the stock market, right? So you've got this channel building. We'll make it blue just to make it different, or any other color just to make it different. And this way you can see the difference in the channels. So now we are no longer doing what we were doing, which was moving up in our dollar index. Now we are moving down, and that is clear as can be. But the trick is, you used to use the 70 bar moving average to time your dollars. Now you will be using the 13 bar moving average to time your dollars and sell rallies inside of this ugly looking environment. What other windows do I have planned that I won't be able to see without my bifocals? Anyway, let me throw on some binoculars and see if I can actually see what, oh, I can read those now. Let's see what we should look at next. Okay, we can roll out to some stocks. Traders, Nvidia. A lot was happening on this chart when we looked at it last. One of the things that was really important was the knock technique. And I was showing this to you at the time, and I said, you cannot knock on a stock door this many times without it opening. At the time, we only had 4 knocks. If anyone remembers the chart, I remember it clearly. Well, we knocked a 5th time here. So what do I mean by knocking on the door? Well, here's the door. Knock. It doesn't open. Knock. It doesn't open. And goes back up. hits it again, knock, it doesn't open. Knock, it doesn't open. This time it has a big rally. Boom, boom. And when it hits this time, the door finally opens, just as we suspected. And down the market went. At the same time, we talked about use the 90 bar moving average, simple moving average as your trigger. That was then. Let's move to today. What's happened today? We got above this crazy red channel, thank goodness. We used the 90 bar moving average to become a buyer instead of a seller. Look at what the market's done. Used to be when you hit the 90, you sold, right? Boom, gets up to 90, you sell. If it moves down, it gets back to the 90, you sell. All right. Well, look what happened as of here. It started to become a buyer. You hit the 90, you can start buying. The last dip below is here, and the rally takes place. So we are above the 90 bar moving average. Top day. What can we use now? Here's the old information. Let's go to the new information. We are above the 90 bar moving average on Nvidia. It's above the red resistance channel. It's above the 252 bar moving average. Now, why is that one important? Because there are about 252 trading days in the year on average. That is an average of every trading day for the year. It's a smart average. It's not used often because it's not in the way of a market a lot of times. It happened to get involved in Nvidia, so I thought I would show it to you. We are above the 252 bar moving average, the green teal average right here, and in a nice channel moving higher. All right, so we're in a channel. We're above the red resistance. We're above the 252 bar, which is the yearly moving average. The tip, buy dips at the bottom of the channel, blue channel, and the 200 bar moving average. So if you get near this stuff, you buy dips. You get near this, you buy the dip. That's how we would trade Nvidia, unless the landscape suddenly changes from there. Let's see if there's anything else on our docket. All right, we did Nvidia. Let's do Zoom. This one, this is such a giveaway. In the past, when we looked at Zoom a few months ago, our technical analysis together as a team, as a class, you cats with me, we came up with use the 55 bar moving average as your trigger. That is your trigger. All right, so the 55 bar moving average worked really well here and here and here. Every time you get near it, it just works perfectly. Look at this. Boom, it drops. Gets here, gets above, holds, holds, has a little work, drops, boom, boom. Every time you get near it, it works. So the only thing I can say about Zoom right now is the tip on this chart is you can continue using Zoom and the 55 bar moving average. So the 55 bar simple moving average is your trigger on Zoom. Keep using it. It was working months ago. It is still what Wall Street is using today. So if that helps you on Zoom, if you're a Zoom trader, that's what you should be using. And what else do we have? The NASDAQ Weekly. We looked at this chart in our last presentation. And you know what? Let's get back to this puppy. That's why I wrote that. I looked at that last night and said, we'll get back to this at the end of the presentation. Let's go look at a couple more, and we'll come back to NASDAQ. What else is in our windows here? If we don't do the NASI down here, we can do this guy. All right. So now we're out to weeklies. Those daily charts were for shorter term trading. These weekly charts are more for direction. Where is this direction going? What do we have going on here? Dow Jones Industrial Weekly. It has gotten above or held above the 200 bar moving average, is in a bull flag, is above this red channel line on the weekly. I'm telling you, that's complexion changing here, kids. Boom. We are above the red channel, above the 200 bar moving average, in a bull flag, and then there's this. you've got the 50-ball moving average in play. You see how up here, let me grab a little tool. Up here, the 50-ball moving average kept us in check. Let me just make that a little thicker so you can see my little point out tool here. If you look, that 50-ball moving average started to keep us in check. Here again. And here again. But look at what's happened since. Now we are above that average. Here, look. Now we are above that average. In a bull flag. Above the red channel. Complexion changing weekly and daily, kids. The tip on here, buy dips down to the 50-ball moving average or the bottom of the flag. They're both in the same place. What else do we have to look at? Binoculars, telescopes. All right, we did the training, right? We've got the E-mini S&P. Oh, this one is powerful. Look at this one. So, E-mini S&P on the weekly bar with the 200-ball moving average running through it. During COVID, you broke through it. In every other chart I've shown you, by the way, you broke through during COVID. You broke through the 200-ball moving average several times on the weekly, going back to 2000, 2008. So you came down and smashed through the 200-ball moving average like it did during COVID right here, like it did in many instances going back to the year 2000. S&P did. The transportation average broke the 200-bar. The Russell broke the 200-bar. The S&P broke the 200-bar. All of them broke the 200-ball moving average, which is why it's so important they're back above. See here how we held the 200-ball moving average right here? And the important thing is this. Look at the horrid resistance that started here. Look at this drop to a rally, right? First thing you do is crack seriously hard. Back up, cracks seriously hard. Where to? The 200-ball moving average. That's what Wall Street watches, I promise. Back up, not the only thing, but they watch that like a hawk. Back down, but look at the difference today. We are above for the first time in who knows how long. Look, that is different. Different. Above the 200-ball moving average. Wonderful, we knew that. But getting above that weekly resistance on a weekly bar doesn't happen very easily. It is finally happening. So the tip here is if we could spend one more week above that red bar, that red resistance, away you will start to go. Wall Street is watching this. I promise you. Wall Street is watching. They see it getting above that resistance. They know. And then there's this. This is our indicator. After all the charts I looked at, and I looked at a lot more than the ones I showed you, and I spent a lot of time going back for years and years, and I am telling you, the NASDAQ, if you glean nothing else, if you get nothing else from today's presentation, this is our indicator. There's almost nothing else you need to use. It's rock solid. Why? See this dip during COVID? Well, this is the 200-ball moving average, right? Right here. This green, whatever color you want to call it. 200-ball moving average. Even during COVID, we could not get below the 200-ball moving average. Thank you. Well, let me grab that. Even during COVID, the COVID drop, you didn't get below. Here, you did not get below. Let's go back. Let's go back. You don't get below until 2008. That's the only time. And it was brief. Boom. Right back up. And that is it. The NASDAQ is never below the 200-ball moving average on the weekly. It just doesn't happen. Except for 2008. And then we had recent. Recently, we'll blow it up a little. Look at all the weeks that we were starting to spend below the average. These are weekly bars. That's 5 days at a time. 5, 10, 15, 20, 25, 30, 35, 40, 45, 50 days below the average, if not more. Started to get scary. But look, we're saved. Above the average, above the resistance. This is big. So, as we were starting to get below that average, I was starting to wonder, hey, wait a minute, you don't get below the average only the 2008 crash was able to do that. What is going on here? Well, thank goodness we got back above that average, and I'm happy to see that now we can start looking for upside. As long as we don't get back below the 200 ball moving average on the NASDAQ weekly, I promise you that this is the chart that you use for sense of direction. This is major. That's a wonderful thing that we're seeing right there. And this is what I wanted to present to you. I wanted you to see all the charts that I looked at. I wanted to make sure that if there were any tips that I found that will help me moving forward, that I shared them with you. So that's about it. I can go pull up 500 more charts and bore you to death, but I wanted to show you the important ones that are helping to mold the immediate future of our stock market, individual stocks, some crypto. It basically encompasses just about everything. Now, traders, if you'd like more of this, you could literally just come to livewithoscar.com. It's livewithoscar.com, just like that. You would simply come over here and register. If you don't have a username, takes no information, no credit cards. Once you registered, you would just log into my chat room. You'd end up here. You click daily chat, and you can chat with me live. You just got to fill your stuff out and be in a live chat room with me on camera and microphone, literally just like this. And if you'd like to join me while I go over these charts, there's usually a lot of people in the trading room and blah, blah, blah. Of course, it's closed at the moment while I'm doing my webinar, but it's that easy to get to. Just wanted to show that to you. You can also go to OMNI BOOTCAMP, and you can fill out an application there if you want to hang out with me in one of my 5-day sessions I hold here in Las Vegas, where I teach people in person. But barring that, kids, there's nothing here to sell you. I just want you to come hang out with me on my site and spend some time with me. So meet me at livewithoscar.com. Spend time with me in my live trading room. It won't cost you anything anyway, and we'll continue going over charts like this together. And hopefully we get something right and we make some money together this year. Thank you for tuning in. If there are any questions, I've got about 3 minutes. I can take them.
Okay, let's go quite fast then, because we have a ton of questions for you, Oscar.
Okay.
Amit says he sure is a force of nature. And let's see. B wanted to know, in your years of experience, does the Fed or exogenous events overrule the charts?
Does the Fed overrule the charts? Yeah. Absolutely, positively, 100%. If the Fed sneezes, wouldn't matter what the chart read was, it goes out the window. But there's not many entities bigger than that. It's one of the few things you need to worry about in the world. Barring that, the chart is stronger than almost anything else. But yes, the Fed's a little stronger than the chart.
There's a saying, don't fight the Fed.
No, not the Fed. If you would have asked me anything else, I would have said no. But when you said the Fed, stronger than the chart.
I thought you were going to say it'll be showing up in the charts.
If the Fed decides to sneeze, that's the end of that. New direction goes our way, and that's that. They are bigger than any other entity that's ever come near the markets. They do control overall which way the markets go. They do not control the day-to-day movement. But if you're raising rates, the market's going to get pushed down a little. If you're lowering rates, it's going to get pushed up. In that way, they control the movement.
All right. Bar charts better for trend lines than candlesticks?
So I don't like candlesticks. I mean, we can turn this into a candle, and I could show you why in a split second. Let me see if I can just make this a candle real fast. So right now, before I make it candles, we have a bar that's just a straight bar with a high-low close. That's all the information. When we apply this, what is this crazy nonsense? Where's the high? Where's the low? Why is it? It's got a wick. It doesn't have a wick. It's got a body. Is the body full? Is it not full? Why are we adding so much information into something and complicating something that should be this simple? A simple, I don't know if I can find it, a simple bar is so much easier. There's so much less information to overcomplicate an already complicated business. So I don't want to have to deal with drawing trend lines on the tops of bodies and or the bottoms of wicks. It's just confusing. In fact, if you have a moment, I actually wrote a program in the 80s into the 90s. It was the first program to ever take candlesticks and put them on a computer. I go back that far. And We were like, wow, candlesticks live on a screen. This is amazing. Oscar, what do they mean? So I went and spent a year and came up with every, well, 2 years, came up with every formation I can possibly come up with what a Japanese candlestick means. I put those formations in the book, in the program, so that when you pulled up a chart right on top of the bar, it would tell you what it was. And after the 2 years of research, I told the team that built the program, I will never use candlesticks again for the rest of my life. And I stopped using them from that day. So the program still exists, but I don't use it. It cured me from using candlesticks.
All right. Next question. Do you use fundamentals at all on stocks?
So fundamentals come out in the charts first. Yes, you must pay attention to them, but almost always the chart is giving you a good read before the fundamentals. For instance, CPI, PPI, and then consumer prices and end production for the first time all came out better. And look at what we've done already. The chart's already showing that now you're above resistance. You see, it does come out in the charts.
All right. B wants to know what is the secret sauce to the MAs and how do you pick them?
So there really isn't a secret sauce. As far as I'm concerned, a good moving average stays out of the market's way, like that one right there. So an average that I find doesn't work is, let's say, something like this. You see how it's just all over the chart? It's on it, it's through it, it's just all over it. For me, which one was right? Which one was wrong? Should we take the trade? Should we not? So I like to see averages that look like this, far away from anything, so that when you get to them, like this, you come smashing down, meaningful, right? Then it stays out of your hair, comes down, meaningful. Those are about the only averages I like to use. Now, the only difference is I don't choose the averages. Wall Street does. I just follow what they're doing. In other words, no one calls me up to tell me. I see what average fits perfectly on the chart. I know that's their average, and that's how I find it.
All right. Let's see. Richard says, Oscar, thank you. I enjoyed your analysis. What's the best time to log into your room?
Either when the sun's up or the moon's up, or neither of those two are up and it's cloudy. All those times are good. Within 24 hours a day, when you're awake, come log in. So in other words, I work the evening markets, I work the day markets, I work the night markets, I work the afternoon markets. We start at 6 p.m. on Sunday evening, and we continue until 5 p.m. Friday evening at the end of the week. So we're always here. Just come join.
All right. Oscar, I want to say thank you for coming. In addition to all the great comments we have, I always think you do a wonderful job. It's always so good to have you.
Thank you so much. I enjoyed this, as I always do. And I hope I left a few tips out there for others that can, hopefully it'll help them moving forward for the next few weeks.
I think so. Thank you. Appreciate it.
Thank you, everybody. I appreciate you tuning in. I hope I was able to help. Please come join me at livewithoscar.com. Jeff, Metastock, thank you so much.